So I'm Simon Bishop. I'm the head of Singapore for Corpay, cross-border payments company based in Singapore. We are listed on the New York Stock Exchange, but our Singapore office is one of our fastest growing globally, and we're seeing a lot of commodities business, a lot of trade finance related business as well that we support. We don't do the trade finance, but we certainly help out on all of the ancillaries around anything to do with cross-border payment. So commodity traders have two parts. So they do a lot of, or the majority of it's US dollar to US dollar transactions. So we don't get involved in that generally because there's no risk involved in the transaction. Where we do become involved is where there is a foreign currency that is either they are purchasing and then receiving dollars later, or they're paying something in dollars and receiving a foreign currency at a later stage. Where we sit in is effectively managing the risk between what could happen at the inception of the transaction and what they actually get paid in. And hopefully there isn't any pain for the client. So we do a lot of forward contracts under that basis. There's many ways that you can manage a risk of foreign exchange. You can do a natural hedge, which is the underlying transaction is in the same currency. But it's very difficult to do that unless you have a trade that is actually in that same currency. Most of our commodity guys and commodity clients are looking at just forward contracts. So a forward contract is where you effectively lock in the exchange rate of a different currency being converted into a base currency at some point in the future. So if there is a difference in currency, we can quite easily completely remove the risk on that. In the commodities space, most of our clients will do a back-to-back hedge. So they will do a transaction in euro, receiving US dollars, and then they will look to convert that back via a forward contract at some stage in the future. The US dollar is the vast majority of the transactions. They are generally have a US dollar involved at some point, whether it be a dollar to dollar transaction. But what we have seen over the last 12 months is the CNH, so the offshore Chinese renminbi, has been a lot more increase in trade, in particular with commodities. Why is that the case? Certainly China's influence in the broader region has made it easier for those transactions to occur. We are seeing a little bit prior to the war, a lot more around what's happening in the Middle East being denominated in AED. But most of the transactions are in dollar to dollar. We do see, depending on where the underlying commodity comes from, there may well be a purchase of euro that is being received in US dollars at a later stage, but we're seeing an increase. There's certainly been an increase, in particular the CNH, because the CNH market is very liquid, it's very easy to hedge, and it allows for the facilitation of the transactions into mainland China to be done quite simply. Hedging, you've got to be able to remove your risk. If you're going to be putting a transaction that involves a local currency, you don't want to bring in a risk that you cannot manage, right? And that's where hedging comes into place. It is quite often that clients will be able to facilitate a transaction more easily if it is denominated in a local currency. And they may be able to get a discount. For instance, if they're paying in IDR or in Malaysian ringgit or something of that nature, they may well actually be able to get a discount. But you need to be able to remove that risk because you're taking the risk away from the supplier, for instance, and taking it to yourself. So, but it's quite easy to do that. We do a lot of hedging in exotic currencies so long as there's an NDF market, so a non-deliverable forward. And clients are happy to do that because of the discount that they get in the underlying transaction is offset by, I wouldn't say the pain, but the more complexity in terms of rather than doing US dollars to US dollars, they just do a basic hedge in the local currency.